With index investing, right, and passive investing, a lot of folks take a look at that and go, in this kind of environment, maybe this is the safer route to go, right? More diversified, less risk, although they probably will have to contend with slightly lower returns as well. Is that fair?
Actually, Martin, if I can disagree politely, no, I think it's not fair. I think if you look, we published the S&P Indexing versus Active reports, or we call SPIVA. We've been doing that for 20 years in the U.S., and now we do it across 20 countries around the world. And the latest results really show in the past year, for example, your active Japanese active managers, 62% underperform large cap passive, or their benchmarks. In the U.S., that grows to 78%. And then if you move to a 10-year period, over 90% of active Japanese domestic large cap managers, and similarly in the U.S., over 90% underperform their benchmark. So, passive or index investment, the lower costs, the transparency, it makes sense for people long term. And again, there can be places for active, but the numbers just frankly don't hold up very well for buy and hold investors.
All right, so listen, I need to ask you here, right, because we've been talking about this for weeks now, if not months, right? This whole move away from U.S. and also specifically dollar-based assets. What does this mean for index investing?
Yeah, so again, diversification is critical here. We've seen really, the tariffs and everything that's happened, this calendar year. But we've also seen over the past decade a reversal out of very, very low interest rate, environments, quantitative, easing. And now we've seen steepening yield curves. Clearly, the last couple of weeks, bond auctions, treasury bond auctions in the U.S., as well as government bond auctions here have not gone well. So you've seen a steepening of the yield curve. Risk premia, equities, fixed income, those are kind of mean reverting back to historical levels after these record low rates. Then obviously you layer in kind of tariffs and more macro kind of uncertainty. But what it really shows is, as you mentioned, a weaker dollar around the world in the last couple of months. So there's been more opportunity, mean reversion to non-U.S. equities, particularly Asia. Japan has been a big recipient of that as well. So we're seeing that rotation. But within the U.S. market, it's fascinating. Domestic, especially wealth management investors, have had record inflows in the U.S. So while you've seen foreign investors, if you will, pulling capital back to home markets, the U.S. domestic demand in equities, and it's led to this very strong rally we've seen in May. Flows have been resilient within the domestic market, but again, international investors finding perhaps more value elsewhere.